Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in 30 minutes. Let's get to the stories we're following in the BNN Bloomberg newsroom. The Canadian economy added fewer jobs than expected last month, failing to offset recent losses. Data from StatsCan shows 14,000 jobs were added in March, missing the estimate of 15,000 by economists. It's the first increase, though, in jobs for the year, driven by services and natural resources. The unemployment rate held steady at 6.7%.
You got to take all of these numbers together. And what they highlight is, I think, a fairly stable labor market over the past year. The 6.7% unemployment rate is pretty close to what it was a year ago. This is not a job seekers market. There's all the challenges that have built up for Canadian workers looking for new jobs, looking to get into the labor market, youth unemployment. These all persist. But momentum-wise, it looks like things held steady.
The U.S. President Donald Trump says Iran's doing a very poor job of handling the Strait of Hormuz, saying the country's not following the agreement in place. Iranian lawmakers claim some ships going through the strait are being charged fees as high as $2 million. These comments come ahead of official discussions between the countries scheduled for Saturday. Shares of Cogeco Communications in the red today. The company missed revenue and profit estimates in its latest quarter. Sales in its American Telecom unit also came in below expectations, and Cogeco cut its full-year revenue and profit forecast. A look at where we stand on the markets, with the TSX rebounding today, up 202 points, or 0.6%. In the U.S., a bit more of a mixed day. The S&P hasn't moved much. It's down 7 points on the day. The Dow Jones down 0.6%. That's a 290-point drop. And the Nasdaq up 0.4. That's an 85-point move to the positive. So a modest rebound in the labor market for Canada in March, a gain of 14,000 jobs. It follows 2 months of losses. My next guest believes the Bank of Canada will keep rates unchanged this year. Let's go to BNN regular Earl Davis, head of fixed income and money markets at BMO Global Asset Management. Thanks for joining us today.
Thank you and good afternoon.
So the report does look weak, but where do the primary sources of gains come from?
Yeah, the primary sources of gain come from services. It's your non-manufacturing areas, the areas that are impacted less by the tariffs. So you're seeing that in retail and services area, with manufacturing still being very lackluster.
Okay, the loss in manufacturing reported 44,000 year over year, up a few thousand though month to month. Is this still, do you think, tariff working through?
Yeah, that's an interesting question. I would say that's part of what's working through is definitely the tariffs and impacts on manufacturing. The other thing that's working through is the uncertainty around CUSMA. No big manufacturing plants making any large investments or investments announcements until they understand what the economics of that investment are going forward. And they will not have an understanding of that until the CUSMA negotiations are completed. So I'd say there's two factors impacting manufacturing. Tariffs, definitely one. And the other one is the CUSMA uncertainty.
What are you noticing in finance, real estate, insurance? We know the housing sector has pretty much stalled out for quite some time. So what have you noticed there?
Well, there's a few things. One is there's a deep overhang, and this is one of the reasons why we think the Bank of Canada is on hold this year, not going to hike like the market is discounting. It's because there's a big overhang of housing that has to go through new construction and whatnot, and you also have to try to stimulate new builds and the like. And although housing is not part of Bank of Canada's direct mandate, it is something that impacts the economy and impacts demand, and that's one of the things they look at from inflation. So I think it will have an impact on the Bank of Canada, keep them from hiking like the market's saying, and in a worst case scenario, there's an opening for them to ease.
You were surprised by wage growth, Earl. Tell me why.
Yeah, wage growth usually comes from a demand for employees. So in this market where you're having a net job loss this year, it's not that saying there's lower demand for employees, so there's less pressure on it. So it's one of those things which could be a one-off number. We have to see what the trend is, and you usually need 3 prints to see that. So we have to see if it goes back to where it was before, call it 4.5% to 4%. Ideally, the Bank of Canada would like to see 3 to 3.5%. So that's something we're keeping an eye on going forward. That would have given us concern with the Bank of Canada and the chances that they could possibly hike. It does not in this case. And the reason why is the Bank of Canada looks at wage inflation closely, but they look at it from what they call a wage price spiral. Will higher wages lead to higher prices because employers have to pay their employees more? And the answer in this case is no, because growth is, let's call it, it's positive, but growth is not red hot. So there's the chance of a wage price spiral, which what the Bank of Canada fears, is very low.
Okay, so you indicated the Bank of Canada's next move could be a rate cut. On what timeline?
Well, if it is going to be a rate cut, it's going to be a 2027 story. Don't see it in 2026. And the reason why we don't see it in 2026 is that actually Canada is immune from a holistic GDP Canadian growth perspective. It's largely immune from higher oil prices because it benefits from higher oil prices, which means there may be more tax revenue going into the federal government. So that gives them additional dollars to redistribute, so to speak, if need be. So we don't foresee an ease in 2026. But if the growth really turns lower, and let's say if the chances of a recession increase, that's going to be a 2027 story. That's when we would foresee the ease come through.
Okay, so
our base case is on hold, but we would see an ease as a higher probability than a hike.
If we're looking for a turnaround in the job market, what else do you see being perhaps an overhang? You mentioned CUSMA for one, and that will continue, I guess, for several months.
Yeah, I actually think it's defense. A lot of the spending or public spending going into defense, like tens of billions of dollars, could create new industries there, and I think that is the objective. Having said that, that is a medium to long-term story. We won't see the benefits of those job creations until 2027. So I think 2026 is going to be a lot of what we see now, job growth around hopefully positive, but around what we see now, very low. We don't anticipate the unemployment rate going above 7. I think if it does go above 7, the Bank of Canada accelerates when they would ease. So we see a lot of the market for the balance of the year staying where it is now.
Okay, you mentioned that perhaps some of the infrastructure spend out by the government won't really come until next year. We already saw the Port of Montreal expansion get underway only sort of 7 months after going through the process. Could that timeline that you have now be fast-tracked if some of these projects do get out of the door faster?
It very definitely could be, and the reason why I think Prime Minister Carney has done a fantastic job in regards to putting the right people in the right places to get things through. And I think that is part of the objective. We're seeing a bit of the benefit in what you just described in regards to the 7-month turnaround. That's almost unheard of when you talk to large government infrastructure spends. So yes, if that continues, there's most definitely a possibility of it being seen in 2026. But that's part of the reason why I said 2027. That in and of itself is 7 months away. Call it, or 8 months away. So I do think, that turnaround, there is the possibility that we see jobs brought forward, but I think 2027 could be a positive year.
Earl Davis, I'm going to leave it there with you. Thanks for your time today.
Thank you.
Coming up next, U.S. consumer prices rose sharply in March because of the energy prices moving higher. More in a moment. Today's U.S. CPI data provides a first indication of how that war in Iran has affected consumer prices. Headline inflation up 3.3% in March compared to the year before, up from 2.4% in February. But is it only the beginning of a prolonged energy crisis? Let's go to Andrew Sizarowski on this, Strategic Income Portfolio Manager, Morgan Stanley Investment Management. Thanks for joining us today.
Thanks for having me.
Are things going to get worse?
I think unfortunately for inflation, we're going to see inflation go higher before it goes lower, and that's because we have this report that came out today, but this doesn't even show the full impact of higher energy prices. It hasn't fully bled through to airfares. You're seeing kind of more of that pain happen in early April. So I think that the next report's going to be bad as well, and then hopefully after that things can kind of settle back down and we can resume kind of the deceleration in inflation we saw right before the Iran war broke out.
Yeah, as you mentioned, core inflation is still subdued right now, but to what extent could that rising energy now move out into other sectors?
I think it's unfortunate. I think it's going to bleed out into other sectors. As you mentioned, you see this. It'll happen in shipping costs, which will impact the price of goods. It'll happen in airfares. And so that's all on the negative side of things. I think there is some positives in this report, though. If you look at the core services and core goods, they actually came in well below expectations. And so core CPI rising just 0.2%, despite us continuing to see kind of tariffs bleed into these numbers, I think was actually a positive for the Fed. So I don't think the Fed's actually going to react to this in any way, and they won't actually see it as negative as the headline print actually shows.
All right. So right now we know reserves have helped to offset some of the shortages, at least in North America, but that could soon change. What is your gloomiest forecast for energy?
Yeah, I think the gloomiest forecast is that this Iran war reaccelerates and we see a resumption in higher oil prices. And the longer it goes on, the more painful it's going to be for the consumer. And we already know the low end consumer here in the United States was fairly strapped. There was supposed to be a strong tax return season, and they were supposed to have some extra discretionary income. But this is going to eat into that. So it's going to have a negative impact on growth. And the longer it goes on, it kind of compounds. So I think that it's one of these things that if you look at what the oil market's pricing in, you see this kind of backwardation. So the oil market's expecting over the next couple months oil to be about $20 lower. But again, the longer it goes on, we will be kind of eating those spot prices.
Andrew, does Washington have some way to move on this, policies it can change or put in place to help the average consumer in the U.S.?
I mean, I think there's short-term things they can do. Obviously, you talked about kind of tapping our reserves here, but I think the quickest way to get oil prices down and gas prices down is obviously to come to some sort of agreement in the Middle East, and the longer that takes, the more painful it'll be. So I think that's the quickest resolution, unfortunately.
Do you think the U.S. or Washington would move to ban exports of energy?
I think that's something that if this was going to be a more prolonged war, then I think that's something they would look at. Hopefully it doesn't come to that. And it's one of those things. I think that the administration is probably looking for kind of outs in the current war. And so I don't expect that to be on the table unless things kind of heat back up.
I do want to get you on rate cuts, which you did touch on a little bit. Consumer sentiment, of course, pretty low. We know that's in record low territory. So given what's going on, as we mentioned, consumers paying more for energy and also their sentiment is low. Do you expect that to be part of the consideration for the Federal Reserve when they're thinking about rate increases?
Yeah, I think prior to the war, the Fed was on a course where inflation was actually declining, and they were going to be able to cut rates a couple times this year. Now, I think what the war in Iran has done, and obviously it's caused this spike in inflation, but I think what it's done is delayed these rate cuts. It hasn't denied them altogether. And the reason why I think that is because I think you were just talking about the Canadian labor market. I think the U.S. labor market, if you put aside the last print we had last Friday, 5 of the last 10 prints we've had on payrolls in the United States have been negative. So this is not a strong labor market here. It's been kind of gradually weakening over time, and I don't think it's reaccelerated just from that one print. And so I think that's what the Fed has a dual mandate here. We know they're missing on the inflation side, but they're also starting to be more and more concerned with the labor market. And that's what I think eventually wins the day when this war in Iran kind of comes to an end. I think that's where they'll be focused as you get to the back half of the year.
If you factor in Kevin Warsh coming in, how does that play out?
Yeah, look, I think unfortunately for Kevin Warsh, and he's going to end up running into the same battles that Jerome Powell has had in office, which is that he's not going to be able to come in and just cut rates instantly. He's going to have to kind of build a coalition. The rest of the FOMC is going to want to see the data to lead it to want to cut rates more. And again, I think it'll eventually get there, but whenever Warsh gets through Congress, which I think could take a little time, it's not going to be something where he comes in right away. It's going to take the same amount of time I think it would have taken Powell. I don't think Powell was someone who was super hawkish. So I think that the data is going to have to be there. And by data, I mean we're going to need to see a kind of resumption in the deceleration in inflation and then weaker labor market prints.
Andrew, I'm going to leave it there. I'm out of time, but thank you for your time. Appreciate it.
Thank you.
Coming up next, North American markets trading mixed today. After the break, a look at several earnings reports. Back in a moment. CoreWeave shares jumped after the company unveiled a deal with Anthropic to power its Claude AI model, and it came after announcing a $21 billion partnership with Meta. For more, our colleagues were joined by Michael Intrater, co-founder, CEO, president of CoreWeave.
It has been a unique couple of weeks for us here, because not only have we really made tremendous progress with the likes of Meta and Anthropic, but we've also had tremendous, overwhelming success in the capital markets as we continue to build the funding mechanisms to be able to ensure that we are able to execute on our roadmap for growth.
Let's talk about those funding mechanisms, because you're looking at unique ways to be able to get access to credit lines by using basically the power of your customer, the fact that Meta is the one that's coming to you for the compute and the strength there. You're also tapping, convertible notes was what was issued yesterday, as well as bonds. We're seeking billions of that. How much more debt are you going to have to take on to fuel the growth?
So, we've been very creative about how we kind of look at the capital markets, making sure that we can execute on our plan in the most cost-effective way. And so, we issued $8.5 billion worth of bonds at A- paper because of the quality of our counterparties. And, that was a tremendous reduction in our weighted average cost of capital. And then we came back yesterday, we did the largest dual offering ever. And that was both the convertible note that we issued, as well as a tranche of high yield, really positioning us well for the capital requirements. And it's just the oversubscription to these tools that we're bringing into market, to the paper that we're bringing to market, really provides tremendous transparency to us, to our investors, to our clients about how much access we are going to be given to capital as we continue to execute on this strategy. And, people are really confident the cost of capital keeps coming down in our ability to kind of drive the compute that is so dear to all of these model creators and product people who are producing product for artificial intelligence. It's just been an extraordinary week, both on the capital raise side as well as the client contract side.
As the cost of capital comes down, you're going to tap more. How much more money do you need to get from the debt markets, Michael?
Yeah, so look, our strategy continues to be success driven, right? And so we go out and we execute a contract like the one we just did with Meta. And now with that contract in hand, we will go into the capital markets and we will raise debt that will be at a very low cost of capital to be able to build the infrastructure to deliver on that contract. Each of our contracts are profitable and drive wonderful return. And at the parent co, we're just looking to continue to scale into this, unique opportunity to kind of build, an enormous company that is instrumental in delivering infrastructure to the world.
How much does Anthropic need?
So we're not at liberty to speak to the size of that contract. It is a multi-billion-dollar contract, but really much more importantly than that, from our perspective, this is the first contract that we've executed with them. It's the first time that they've used somebody out of one of their core investors, and they came to us because of the quality of the infrastructure and the software solutions that we provide. And so, we just think it's an incredible vote of confidence from one of the most important labs in the world. And we think that it's going to be a launch pad for additional business between us and them, just as every other client that we've brought on, really all the major clients. They come on, they do a contract with us, and it's a land and expand strategy for both parties. We really build from that into a very broad-based relationship where we become an integral part of their infrastructure strategy.
Let's talk about Mythos. Does the slow unveil of the model to unique partners, does that signal an issue with compute?
So look, the strategy that Anthropic is using to, as they kind of bring their products to market is really, it's their strategy. Our job in this ecosystem is to provide as much infrastructure at the highest quality that we can, right? And they came to us, they engaged us because they have demand for compute because of the wonderful products that they are bringing to market, and that's being echoed across the different labs, universally. And our role in this is really to go ahead and to deliver the infrastructure that these companies are going to need and currently need to be able to successfully deliver their product to market. That's what our role is. We do.
Michael, I'm fascinated by the global perspective you have here, because the geopolitical environment that we live in at the moment means that energy prices are driving up, particularly over in Europe and the UK. OpenAI, we have reporting that they're pulling back on their Stargate project in the UK because energy is getting too expensive. And yet they're going out to their investors and saying, look, we're ahead of the game, we're ahead of Anthropic because of our compute that we have. What are you seeing in terms of people trying to rearrange where their compute is accessed from?
Yeah, look, the way I kind of view it, and my background really is within the commodity space, is that people are going to be very thoughtful about managing the cost of delivering infrastructure. And some of that is going to come from the energy side. It's going to be, hey, where can we get electrons that are effectively priced so that we can continue to drive our company? But it's also going to come from places like CoreWeave, where our software and the yield on the compute that we build is just higher than other alternatives because of the quality of the software environment that we build. And so you're seeing both sides of that coin really being driven, and you're seeing the success of our infrastructure and the adoption of our infrastructure because of the part that we can impact. And so we look at the different energy markets. We place our infrastructure in lots of different places in order to mitigate localized risks, such as what's happening in Europe at the moment. But we really do think that the part that we can directly control is the quality of the infrastructure we deliver.
Would you pull back from the UK, Michael?
No, we have no intention of pulling back from the UK. We are well positioned there. We have a great relationship with the energy companies, with the data centers, and with the broader economy over there. And we absolutely will continue to build and expand our footprint in those jurisdictions.
Here are the closing bells for the end of the trading day, the end of the trading week as well. At the NASDAQ United Athletes Tour, ringing the closing bell. In New York, 50th anniversary of the New York Stock Exchange ARCA options trading, ringing the bell. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX a gainer today, up 218 points, or about 0.7%. The S&P not materially moving today. It's down 7.8 points. The NASDAQ up 0.4%. That's a move of 80 points. Let's have a quick look at oil today. Always interesting to watch during the fragile ceasefire with Iran. West Texas Intermediate, the May contract is down 1.7%, $1.67. That takes the price to 96.20-ish at this point in the day. Let's take a look at the movers in Toronto. Celestica was a big gainer today, 7.3% up, or $33.21 a move, taking the share price to $4.86. Parex Resources also moving higher. The company reaffirmed its average production guidance for the full year, moving the stock up 6% or $1.50 per share. Lundin Gold gaining today 4.9%. So that's up $5.54 to $118.32. And we'll get to the losers right now. Cogeco Communications shares falling after its second quarter adjusted earnings per share missed estimates. That took the stock down almost 8% or $5.30 to $61.40. And then Curaleaf Holdings, also a loser today. It does tend to move quite a bit. It's 4.5% down, a loss of 15 cents a share. So the TSX up today and is on track here to end that week higher, despite the conflict, of course, in Iran. Let's bring in Ted Rechtschaffen. He's president and CEO of TriDelta Private Wealth to talk some more about what's been going on. Thanks for joining us today.
Pleasure.
Let's start with Cogeco, which did report earnings, and we saw the stock move down on that. What's your outlook for telecoms in general?
Well, it's a bit of a concern. In Cogeco's case, revenues were down a fair bit. They were talking about U.S. internet space really pulling it down. But in Canada, one of the big drivers has been lower immigration. And it's an interesting one. People talk about the impact on real estate, but it impacts telecom as well. When the business centers around new subscriber growth, and the growth of the country actually shrunk for the first time in many years, a lot of the telecoms are feeling that heat. And then what happens is they tend to compete against each other and lower prices. So the space overall is a little bit of a concern at the moment.
Oh, wait, let's get to Chorus, which reported as well. We know they're in a tough position. We knew that going in. Not much was expected. But what can that company do to improve its financial situation? Does it have assets to sell? What does it do?
Well, there's a singer called Billy Preston. He has a song called "Nothing from Nothing Leaves Nothing."
Yes.
So I don't want to be too depressing about Chorus, but it really is shrinking to a point of getting close to zero at this point. So I don't really have any great ideas. It's been in a tailspin for many years now. So the stock price, I don't know if it was down to 3.5 cents, or was it 35 cents? I think it's 3.5 cents. There's not a lot of market cap left, so I don't have any great ideas for you.
Okay, 5.5 is what I'm hearing is where they're down to. So, not in a good spot. Let's get to MTY Food. They reported sales are changing. What's your take on where they are?
Well, again, MTY is in the franchise business. Companies like Thai Express, Country Style Donuts, they've struggled a little bit. They've actually closed more locations than they've opened in the last period of time. But again, these are businesses that are pretty they're pretty cyclical in terms of a hot name or a not hot name. And so they can turn around pretty quickly, but MTY has certainly struggled a little bit this quarter, and the stock price was down a fair bit today.
Okay, let's get to oil, which has been fluctuating greatly over the past 6 weeks, particularly, and now seems to have separated a little bit from every single headline. First, of course, there was a reaction sort of moment to moment. What's your take on how investors have been reacting and how that has changed over the last, let's say, week with the ceasefire agreement?
Well, someone asked me why the market isn't as volatile as they thought it could be. And I said, I think the market listens to everything Trump says and believes about 10% of it. So when it comes to oil and sort of where we're at the moment, obviously there was some relief. There was a big relief rally when there was a ceasefire announced. The question is, where are we going in the ceasefire, and will it hold? And I think it's pretty tenuous. If I had to guess, I would guess that the ceasefire will not hold and that the price of oil will go back up at some point. But the key thing for us is that, from a U.S. perspective, this in Iran, the war in Iran, has a real timeline. Like, it will not go on 2-3 months from now because of inflation, because of the lack of popularity in the U.S., because of midterm elections. So we think that while there's still a lot of fluctuation, may go up again if there's the breakdown in negotiations. But we think over the next 2, 3, 4 months, oil's coming back down a fair bit.
And do you think it's going to ring in back where it was before conflict, or it'll get higher and stay higher because of the big movement over the past 6 weeks?
I think eventually it'll get back to where it was before the conflict. I don't see If there was no conflict, we didn't see oil particularly going into the 70, 75, $80 range, so I don't see why it would now.
Okay, let's get to a couple of your stock picks then. The first one you like is Canadian National Railway. Based on what?
Well, it's an interesting thing. Sometimes in stock investing, it's a question of, can it meet expectations? And CN's expectations are now pretty muted. So their revenue expectations, their growth expectations are pretty low. But getting back to oil, we think one of the big drivers for CN is the whole rail with energy and oil sector, especially in Prince Rupert, BC. We think there's going to be a big growth there. And so that represents 20% of CN's business. So we think that's going to be a driver, especially as people are looking for more stable regions for oil and more secure oil transportation options.
Okay, so based on that backup in oil, of course, we could see some boom there. Let's talk about Extendicare. I'm going to jump there. Is the fact that you like Extendicare, that based on just sort of population growth? What is that based on?
Well, so Extendicare is doing a few things really interesting. I mean, obviously the stock's up 170-something% in the last year, so that's a big win. And it is actually our biggest holding in the TriDelta Growth Fund and TriDelta Pension Fund. So we're big believers in it. But one of the things they've done is they've acquired a couple of businesses in home health care. So while traditionally Extendicare was more of a real estate, long-term care home type of business, they've really grown a lot into the home health care and into the services space. And just demographically, we see that growth both in stay-at-home care and in long-term care just growing in Canada, and Extendicare is the largest player in that space.
Okay, let's leave it there. Ted, I do want to say Chorus. I double-checked the price. It's 3.5 cents.
Yeah, there you go.
There you go. A little bit of a change. Thanks for coming in. Appreciate it. Good to see you.
Thank you. Take care.
All right. Let's let's take a quick break. We're back in just a moment. U.S. markets a little bit mixed today with March inflation numbers coming in higher, driven by the energy crunch. Our next guest advises investors to remain aware that risk may not be accurately priced. Let's go to Chad Morganlander, Senior Portfolio Manager, Washington Crossing Advisors. Chad, thanks for joining us. Where do you see the risk not priced in?
Well, you could look no further than high yield credit spreads to U.S. Treasuries. That is pretty much at a historic low or pretty darn close to it. You've seen that happen before in 1999 and 2006. So there is an element, I believe, of where the investors are not concerned about the future growth trajectory in the global economy, and so we'd be somewhat more circumspect about that.
Okay, so you also see a nexus between the AI build-out and the private credit troubles, I'll say. Walk us through that.
Yeah, look, I'm not saying that this is the housing crisis 2.0, but a lot of leverage and debt is being utilized to create data centers. There's been a gigantic amount of capital investment in the United States, and that on the back of that, you have earnings growth, and that bodes well. But that capital investment eventually starts to decelerate. And there's also a mismatch, we believe, when it comes to the expectation, the price of compute over the next 5 to 7 years, and what the return on invested capital, or the expected return on invested capital will be. So today, there's a great amount of excitement about the price of compute, the demand for compute. You look no further as Anthropic and what is happening with Meta, but eventually that build out will start to mature. And when that happens, there will be a general concern about these assets. And there could be some stranded assets that bleed into the credit market.
Okay, so what are the metrics you're looking at to determine where to invest in that space?
Well, what we would do when looking at that space is look, we would avoid companies that are taking on an excessive amount of leverage. So for example, you could look at the hyperscalers as a seam of opportunity because they have cash flow and they have a well-connected type of business model. But that's about 40% of this build out here in the United States. The additional 60% is coming from other companies, perhaps on the private equity side, that are raising money. And although everything seems to be perhaps very tranquil in regard to making big, smart business decisions there, that's where you really have to be mindful because the leverage is there. So we would look at companies that are perhaps some of the more resilient blue chip companies within the tech space. And many of those companies, the multiples have come down quite a bit.
You've also noticed a change in market leadership. Where is the money turning to?
Well, you had an enormous amount of leadership from high beta companies over the last 3 years. In particular, when you look at the S&P 500 last year, the 18.8% return, 17.3% of that return came from stocks with a beta above 1. We believe that there will be a reversion now, and you'll start to see lower beta stocks, more steady Eddie companies start to outperform over the course of the next several months and going into the next several quarters.
Okay, so on that, let's talk about where you see opportunity right now. One of your recommendations is Abbott Labs. Tell me about Abbott.
So Abbott's one of the largest med tech companies here in the United States. The interesting thing about this is that it's come off roughly about 25 to 30% off its high. So the multiple has contracted. The revenue growth is roughly between 6 and 7%. That is a very attractive top line growth. The general concern has been in their consumer side for protein drinks, which has decelerated. We think that will reaccelerate over the next 12 to 18 months. The multiples that you saw, this multiple contraction, will eventually normalize. It's got very little debt, it's got a diversified client base, and it's got a growing dividend. We like it a whole lot.
Is there any specific reason you see a continued growth from here in their protein drink space?
Yes, well, the GLP-1 wave is all just at the beginning stages. And we believe that as patients or the population becomes more health focused, that these type of drinks will be a tailwind when it comes to the food side of the business for all the entire food business. So I think they're situated correctly. It's a well-balanced portfolio. And the driver has really been the diabetes monitoring side, which is more of a wearable. And as AI starts to become more integrated into this in real time, we believe that this really bodes well for their portfolio.
Okay, let's get to Cisco quickly. That is another one of your top picks. What do you like about Cisco?
So Cisco's, one of the steady Eddie, reasonably priced AI infrastructure plays. We believe that with very little debt, growing dividend, top line growth between 6 and 7%. That's the expectations. Those expectations are very low. So we believe that they could actually beat that expectation handsomely. And any type of data center or network center across the globe, they're going to need to update their routers as well as their infrastructure backbone, either it be on the data center side or corporate campus side. So there's going to be a massive refresh that will be needed, and we don't believe that it's priced into the market yet.
All right. Chad Morganlander, Senior Portfolio Manager, Washington Crossing Advisors. Thanks for your time.
Thank you.
Coming up, is Canada's office market finally turning a corner? A new report shows vacancy across the country down. Back in a moment. Canada's office market could be turning a corner. A new report from Colliers shows national office vacancy rates fell by a full percentage point from a year ago. For more, we were joined by Adam Jacobs, head of research at Colliers Canada.
The rise in office vacancy and the challenges we were having in the office market, but it couldn't last forever. We spent 5 years with sort of too much supply and not enough demand, and then we woke up in 2026 and found we had too much demand, and suddenly there isn't anything being built. The supply has really come down, and the market, it took a long time for this cycle to work itself through, but we're starting to see it correct itself and come back to a more normal market.
And what's the big driver on that? The biggest one, is it the people going back to work now, or is it what you haven't built? I mean, everything's been put on hold because there was no demand.
It depends a little on the market. I think in Toronto, the story really is return to office. A year ago, that didn't seem likely, and now we're here with every major tenant from government to banks to tech coming back to the office. I think in other parts of the country, that's less of a factor, but just the slowdown in construction, you see it everywhere, in the office market, in the housing market. We're at the tail end of that cycle. A lot of new office was built, and that's not going to be happening for the rest of the decade. So we're starting to see the downtown fill up a little bit, and the demand is really there. We see it from all the usual big tenants, government, tech, banking, insurance. All of those are coming back and leasing more space.
And let's look at and different cities, different locations. You mentioned Toronto. What kind of a change has it seen?
Change, and I think a really big change downtown. The downtown really suffered, I think, more so than the suburbs with the elevated vacancy, with all the new buildings being added. And we're really seeing a much more rapid turnaround for the financial core, the immediate downtown. There's just huge demand there, and that's where the return to office initiatives are really centered. I think in the suburbs, it's been a little more moderated. You haven't seen quite the feast or famine over the last 5 years. But yeah, the story is really centered in downtown Toronto, new buildings, but just really strong leasing, really strong demand from, like I said, kind of the usual suspect tenants. Generally, downtown's usually a tighter, stronger market. That hasn't been the case for the last couple of years. But if you look historically, that's almost always true.
And similar situation in places like Montreal, Ottawa, Calgary, Vancouver?
I think we're seeing it in most of the major markets. Ottawa is always a bit of an outlier because it's just so dependent on what's the federal government doing. But yeah, generally we're seeing that vacancy come down. We're seeing construction really slow to almost zero in most cities. And you even see a few cities like Calgary where it goes the other way. We're converting office towers. We're making them into new uses. So that ends up shrinking the inventory and shrinking the vacancy.
And there is a danger with that. I want to talk about that, the lack of building. What about small markets? Do they kind of go like this a little more than the major markets did? I don't know if you can see my hand movements there. I started doing a little break dance for you.
Yeah, I like it. It's a little less predictable. Those are just smaller markets and maybe a little more influenced by one big relocation, one big new building. But most of the markets we look at, we're seeing the vacancy come down for office. It's just different factors. I think there's also the differential of who's more or less impacted by the trade war and tariffs. Again, big impact in Ontario, maybe less of an impact in Saskatoon and Edmonton and some of the other markets we track.
And the companies, when they're coming back, are they coming back with the same number of people? Are they using the same amount of space, or are new companies coming in?
I think it depends. I think we often underestimate also how much larger the country and certain employers have gotten over the last 6 years. We had really big population growth, and what we're finding is your big employers are saying, we want to go back to 7 or 8 years ago, but they're actually much larger. They have more staff, they have more salespeople, they have more tech people, they have more everything. So even if there's hybrid, there's just been a general swelling of the workforce is larger, and now that's bumping up against a situation where new buildings aren't being built.
And so with that, with the new building, what kind of an impact could we in 5 years go, hey, we have a real shortage now?
I think it's possible, actually. It seems crazy to say that after what we've just gone through, but it's all of this real estate stuff is very cyclical. We see it in home building, we see it in retail, we see it in all the assets. And office was incredibly hot 7 or 8 years ago. Then it went, had the shock of a lifetime with remote work. But if you start to project it forward, there's almost no new construction. The rest of the decade, not much is going to get built. And if you think the population is going to keep growing, the economy is going to keep growing, there is going to hit a point where maybe demand exceeds supply again.
And then we'll be talking about the opposite concerns and issues with that. One of the things you mentioned, I remember when I worked in Vancouver about 20 years ago, they were talking about this as being an issue, that they converted to a lot of places. They were starting to convert to condos because people were commuting out of Vancouver into the suburbs, and then they didn't have office space. Is there any major city that you're seeing the most of that? I think you mentioned Calgary.
Yeah, Calgary is a unique case with the elevated vacancy, but also they've really have a full city government initiative to kind of address some of the longtime vacant buildings. And there's a fair bit of money behind that to make that happen. I think in the other markets, there's a lot of talk about converting office, but everything we hear is it just doesn't make sense financially, given the cost of purchasing an office and re-engineering it for housing. I think it seems like a simple solution, but the practicalities of it are quite different. So aside from a few cases on the margins, I don't think you'll be seeing conversions of office, certainly not in the expensive markets, your Toronto, Vancouver office markets. That's a long way away from happening.
Adam Jacobs is head of research at Colliers Canada. A historic homecoming ahead. The Artemis II crew set to return to Earth tonight. We'll get into details in a moment. The Artemis II crew comes to a dangerous part of its mission tonight, re-entry into the atmosphere around 8 p.m. Eastern Time. It might only be just over 15 minutes, but it'll mean breakneck speeds and temperatures nearly half of the surface of the sun. CTV's Kamal Karamali with the breakdown.
The first thing that'll happen before the Orion spacecraft hits Earth's atmosphere is losing what's called the service module. Gone are the solar panels, engines, and water and air tanks, leaving just the capsule with the crew inside as it hurtles towards Earth at more than 40,000 kilometers an hour. Air compresses in front of the capsule, creating a plasma fireball. This is the most dangerous part of the entire mission, with temperatures reaching 2,700 degrees Celsius. The spacecraft protected by a heat shield, and the crew inside experiencing controlled temperatures. But the process will make them feel 4 times heavier than they do on Earth. Then, to slow itself down, Orion will deploy 11 parachutes in a carefully planned out order. These chutes slow down the capsule to just over 30 kilometers per hour as it splashes down in the Pacific Ocean just off the coast of California, where a recovery team will greet them. The whole journey from entering the Earth's atmosphere to splashdown expected to take just over 15 minutes. Kamal Karamali, CTV News, Toronto.
Straight ahead, what you need to know before filing your taxes this year. Back in a moment. We are ticking down to the tax deadline. Investors always have questions about how to best manage gains and losses when filing. Let's get answers today from Jamie Gollenbeck, Managing Director of Tax and Estate Planning, CIBC Private Wealth. Jamie, before we start, and thanks for coming in, by the way, can we just address sort of any changes this year that generally Canadians need to know about?
Yeah, so there's not a lot that's changed from the 2025 return from the 2024 return. I think the major difference that most people will see is that, in fact, the tax rate has gone down, but only for the lowest bracket. So the lowest bracket has dropped from 15% to 14.5% for 2025. It's actually going down a little bit further to 14% for 2026. But that's kind of the only noticeable change that people will see on the actual tax return itself.
Okay. As an investor, what's the number one thing you need to think about ahead of filing?
Well, again, as an investor, of course, you're going to report all of your, taxable investment income. Different types of investment income are taxed differently. We all know the most tax efficient form of investment income is capital gains. Mm-hmm. If you sold an asset during the year, you report a capital gain. That's only half taxable, 50% taxable. So you report those on your Schedule 3, and then you pay tax on only half the gain. If you receive Canadian dividends, let's say from a bank stock or a dividend portfolio, those are also tax favorable. The difference there is you report what's called a grossed up dividend on the income side of the return, but then you claim a dividend tax credit. So effectively, you pay a lower tax rate on Canadian dividends, taking into effect that the corporation's already paid some corporate tax. So again, if you're using tax software or using a tax accountant, this is all done automatically for you.
Let's talk about foreign income. If you sell an asset, for example, as you mentioned, and make money in the U.S. or get dividend from a U.S. company, how are things looked at differently?
So a little bit differently, let's start with the income. So any foreign income, like as a Canadian resident, you're taxable on worldwide income. So whether that income is here in Canada or it comes from abroad, either a foreign stock or a foreign rental property, that is going to be fully taxable in Canada at your marginal tax rate. If there was foreign taxes withheld, so typically if you have a non-registered account, you invest in U.S. dividend-paying stocks, there might be a 15% withholding tax. You can claim that as a foreign tax credit on your Canadian return so that you don't pay double tax. So that's the income side. Now, on the gain side of it, you do have to report the sale of any property, including a foreign property, and that would be reported on the Schedule 3, taking into account the foreign exchange rate. The one thing that we do keep in mind is that if you have a foreign investment that has a cost of more than $100,000 Canadian, then you must declare that. There's a special form for that called the T1135. If you don't fill out that form, the penalty is $25 a day. For every day you're late, up to $2,500 a year.
That's a serious penalty.
It's a serious penalty. So we remind people, it's right on the beginning of the tax return. Did you own foreign property? Again, this is investment property. This is not personal use property. So if you have a Florida condo, you don't rent it out, no problem. But foreign stocks, even if held a Canadian brokerage account, or a foreign property that you do rent it out, if the cost is over $100,000 at any point in the year, you must declare that on the special form.
Interesting. Okay, let's talk about mistakes commonly made by retail investors. Are there certain ones that you always notice?
Well, the one that we notice, not necessarily at tax time, because it doesn't appear on the tax return, is really coming back to that issue of those foreign taxes. So the most common example, and this really does stump people from time to time, is let's say you do own some U.S. stocks. If you own them in a non-registered account, you're going to get a foreign tax credit. You end up paying your Canadian rate on that foreign dividend. The problem is if you own those foreign U.S. stocks in, let's say, a tax-free savings account. Of course, that's meant to be tax-free. The problem is that the U.S. doesn't recognize that. And in fact, there would be a 15% withholding on that dividend. The net amount goes into TFSA, and it doesn't really become tax-free because you've lost the 15%. With an RSP, there is an exception. If you have U.S. dividends paid into a RSP, in fact, there is an exemption from withholding tax under the Canada-U.S. treaty. So you got to think about that in terms of where you want to hold those U.S. stocks.
Okay. If you have a partner, you're married, common law, are there certain tax strategies as far as being both investors, for example, that you can benefit from?
Well, again, you've got to be very careful because in Canada, we file separate tax returns. We don't have this concept of a joint tax return like they do in the U.S. And Canada also has what we call anti-income splitting rules. We call these the attribution rules. So if you have one spouse or partner in a high bracket and one in a low bracket, if you just sort of give them your money and tell them you invest it, you're in a lower tax bracket, all income and gains attribute back to the higher income spouse. Now, there are some exceptions. There are ways around it. So some easy things that one could do is, for example, in retirement, you're allowed to do pension splitting with retirement income. But there are more sophisticated strategies that a spouse or partner might do, things like prescribed rate loans, where someone loans money to the other spouse, charge the minimum prescribed rate of 3%. Any return above that is not attributed back. So that's where a tax professional should come in to see if that works for that couple.
And that's only available beyond a certain age?
No, it's available at any age.
It is,
but
okay.
Again, you've just got to be careful. You've got to watch these attribution rules because, again, it doesn't apply if you're using a prescribed rate loan at the proper rate. But if you just give money to a spouse, then there's going to be income and gains attributed back. So you've got to be very careful.
Let's talk a little bit about filing by the deadline and how important that is, and how quickly, if you file online, could you expect a return or some sort of response from the CRA?
Yeah, of course, the deadline is April the 30th. And as soon as you file electronically, you can actually get an instant online verification of the notice of assessment by going onto the CRA My account. So once that file is accepted by the CRA and processed, you go online, you can see it right there. You could actually get your refund in as little as 9 business days. We've seen that so far this year. So just keep in mind, deadline is April the 30th, especially if you owe taxes, because if you're even 1 day late, you get a 5% penalty and then 1% every month after that. They also charge you interest on any amounts you owe after April 30th. You technically have till June 15th to file if you're self-employed, but any balance owing is still due on April 30th.
Yeah, that's the one caveat I think people forget again sometimes. Jamie, thanks for coming in. Appreciate it.
My pleasure.
Jamie Goldenbeck is Managing Director, Tax and Estate Planning, CIBC Private Wealth. Coming up, how prediction markets are turning the entire world into a casino. Back in a moment. Prediction markets like Kalshi and Polymarket are blooming. They also face a widening legal battle and criticism over alleged user insider trading. Here's how they got so controversial.
This year's richest person, the existence of aliens, even the return of Jesus Christ. Believe it or not, people are actually betting on stuff like this.
Prediction markets are platforms online where you can bet on future events. The best known platforms are Kalshi, Polymarket, but there are a bunch of others.
And over the past year, they've exploded in popularity.
Kalshi partnered with CNN, CNBC.
Google announcing it will integrate Kalshi's data.
MLB naming Polymarket its official prediction market partner.
We have New York Stock Exchange owner taking a stake into Polymarket.
You're starting to see Polymarket and Kalshi really get into the mainstream vernacular.
If you had me saying potato on Polymarket, you just made a ton of money.
Prediction market app, dude. You know, online peer-to-peer betting.
The amount of money involved has skyrocketed.
Kalshi currently handles $3 billion of notional trading a week. Just at the beginning of 2025, they were handling $30 million. So 100 times more. We're seeing pretty similar numbers for Polymarket.
The boom is creating a new class of market watchers.
You're just placing trades based on the news and the information that you have.
Information is power.
I was able to pay off my student loans with the money I got from Kalshi. I'm putting myself through grad school. I was able to pay off my car.
But most people aren't paying off their bills. They're losing money.
I feel so bad for 18 to 35-year-old males losing so much money.
People are gambling on war.
As the U.S. and Israel prepared to strike Iran, platforms like Polymarket saw a surge in activity.
One of the criticisms of prediction markets is that they've created the financialization of everything. Should you be even allowed to bet on military endeavors, or should that be something that is off limits?
As these markets get more esoteric and specific, they become more easily gameable, more difficult to monitor insider trading and market manipulation.
So what happens when you can bet on almost anything?
From the perspective of the prediction markets, this is not gambling. This is trading a derivative like any other derivative, whether it's wheat futures or something that has real world utility.
Kalshi or any other prediction market, they're regulated by the Commodity and Futures Trading Commission on a federal level.
It's a yes or a no outcome. When you buy shares, they can be priced anywhere from 1 cent to 99 cents. That price is determined by what traders are willing to pay for that outcome at the moment in time.
Unlike sports gambling, prediction markets don't have a house, taking the opposite side of your bet.
We don't actually make money when people lose.
Instead, they match buyers and sellers and generate revenue from transaction fees.
Prediction markets are based on supply and demand. It's a peer-to-peer market. If I place a yes on a certain outcome, whether it's going to rain in Central Park tomorrow, there needs to be enough people thinking that it's not going to rain to take the opposite side of the bet.
And while you're welcome to make predictions about the weather, most people on these platforms are there for sports.
Indiana gonna win, baby!
As of March, around 70% of Kalshi's weekly trading volume was entirely made up of sports-related bets. Sports gambling was mostly illegal in the US until 2018, when the Supreme Court struck down a federal ban. Today, nearly 40 states have legalized it in some form, bringing in billions of dollars in tax revenue each year.
The states that have legalized sports betting are upset because they can't control the sports betting that's going on Kalshi, and crucially, they can't collect tax revenues on it. Now, other states that have not legalized sports betting, they're upset because now without their consent or their control, sports betting is now legal.
Several US states have sued Kalshi, Polymarket, Robinhood, a bunch of other platforms, saying that they should have jurisdiction over what they consider to be sports gambling.
From the consumer's perspective, even though the underlying plumbing is different and the regulations are somewhat different, when you open the app, very much it's the same experience.
Arizona is filing criminal charges against Kalshi, accusing the prediction market exchange of operating an illegal gambling business.
So we see this as a total overstep, and we look forward to fighting it in court.
Most retail investors, regular people on the street, they're probably less interested in betting on what interest rates will be next month, but they're pretty interested in betting on who'll win the Super Bowl.
Billions are also expected to be placed on World Cup outcomes.
93% on Kalshi right now.
Yes.
Chances of victory. This is how we bring the numbers down.
People also like to bet on politics.
Polymarket and Kalshi particularly got big around the 2024 US presidential election.
This election is going to be close, but we are going to win.
Everyone was talking about the odds of President Trump winning the election.
The latest polling from NBC News showing Donald Trump and Kamala Harris neck and neck.
And there was somewhat of a gap.
Those markets actually predicted that Trump would win more accurately than polls did. So that helped improve the reputation of prediction markets.
I, Donald John Trump.
Trump's victory was a win for prediction markets as well.
Donald Trump Jr. is an advisor to Kalshi, and he's both an advisor and an investor in Polymarket. The Trump Media Company has its own prediction market platform that it's announced called Truth Predict.
The Biden administration had been critical and went after Polymarket and Kalshi with mixed results. But the same agency under Trump has come out swinging for the industry to keep it legal.
To those who seek to challenge our authority in this space, let me be clear. We will see you in court.
At the end of the day, there's a limit to regulatory control. Polymarket has since become federally registered and is offering some bets in the US again, even while most people can access the full service via virtual private networks or VPNs. Conversely, Kalshi is trying to expand overseas.
For Kalshi, they've said they want to be available in 140 different countries. That's the goal.
But a cloud of ethical questions linger. Take insider trading. In investing, there are hard rules around who and how information can be used. But here, it's fuzzy.
In the original premise of prediction market, an insider information can be a signal.
I think what's cool about Polymarket is that it creates this financial incentive for people to go and divulge the information to the market and the market to change.
What we often see in these prediction markets, insider trading is not necessarily a bug that needs to be fixed, but it's very much a feature.
From this point of view, people with insider information can profit from it.
The most famous example is someone in the run-up to the US capturing Nicolas Maduro placed a series of large bets that Maduro would be removed from office. And they ended up making $400,000 off of these bets. That was on Polymarket, so those bets were anonymous, but it appears to be someone who had knowledge that this was going to happen.
In some cases, bets don't have to be big to make a difference.
There are so many things to bet on, and some of them don't have a lot of volume or a lot of liquidity. It doesn't take a huge amount of money to move those markets.
Polymarket has introduced rules it says are aimed at curbing trading on non-public information, and Kalshi says it will penalize such behavior or refer it to the CFTC. This evolving set of rules doesn't completely squash the ability to stack odds and profit from insider information, though. And there's also the dubious ethics of being able to bet on conflict or violence.
On Kalshi, you're not allowed to bet on assassination, terrorism, war, because the CFTC has those outlined in its core principles as areas where bets are not permitted. For Polymarket, those rules don't apply because it's international, so it has a lot of markets on areas that people would consider unethical.
Another issue is how outcomes are decided. Kalshi and Polymarket lay out for bettors what event, resolution criteria, and data sources will determine the answer to the wager.
In theory, who wins and who loses should be decided by the real world. That said, there can be hiccups when these markets resolve.
Despite the issues, Kalshi and Polymarket are raising billions of dollars in funding. The boom in online prediction markets is being driven by people like Brandon Feen, a 25-year-old teacher in Pennsylvania.
I am not a finance bro. I have no background on the stock market. My friend actually reached out to me and said that there was a way to bet on the Billboard Hot 100 chart and try to predict what song was going to be #1. And I went, there is no way that that is a real thing, because that is what I have done since I was in 8th grade. My first trade that I did, I lost $600, and I was like, you know what, I'm all done.
But Feen didn't quit. Instead, he approached it like a professional investor would, with research.
Sometimes it'll be hours each day. Sometimes it'll be 1 hour for the week. I have seen success with Taylor Swift markets with her album, how many sales she was going to do. I go on Twitter and I follow fan pages that update on these things, and I turn on post notifications. So super easy. Anyone can do it. Anyone can look at how people are finding this information.
This is the #1 strategy to start making money on Polymarket today.
A lot of people are taking this very seriously and doing a lot of research and trying to get an edge on what they call dumb money, people who are just kind of winging it. And in some cases, the kind of research they were doing was incredibly sophisticated.
A lot of the biggest supporters, they say, wow, this will be bigger than the stock market, this will be bigger than all financial assets, because it allows you to do everything. And perhaps that's part of the promise. But then the other side of the coin, the majority of people go for entertainment. They go to win some money, they go to watch a game.
Be it entertainment or investing, prediction markets tend to produce big winners and lots of losers.
Analysis done by Bloomberg and other outlets shows that, on average, bettors who invest less money in prediction markets tend to lose more often, and those who invest more money, the professional side, they tend to win bigger.
That tendency sounds a lot like Wall Street, where big investors tend to make most of the money. But as with anything this new, everything is subject to change.
It's possible that a lot of this could go away. We're also waiting to see how a lot of these court cases shake out. If the courts decide that trading on prediction markets is the same as sports betting and should be regulated by the states, then that completely changes these companies' business models.
All right, let's take a reminder here of how we ended the day on Bay Street and Wall Street today. A mixed day. The TSX moving up 0.7%, 218-point gain on the day. The S&P not a material move, down today 7 points. The Nasdaq gainer 0.4% up. That's an 80-point gain on the day. We do want to remind you that BNN Bloomberg will have full coverage of Monday night's 3 by-elections. Remember those? Hosted by CTV News chief anchor and senior news editor Omar Sachedina and CTV News chief political correspondent Vashi Kapelos. All of that begins at 7 p.m. Eastern Time. You can watch it on CTV News channel. It's also going to stream at ctvnews.ca if you want to catch it there, and on Crave. Key by-elections happening on Monday. That does it for The Close. Thanks for joining us. Have a good weekend. We'll see you back here on Monday.